Mr. Gori. Welcome to the program.
Thank you very much, Tanem. It's a pleasure to be here.
So let's start off with Fed. So this week, a criminal investigation launched against Fed Chair Powell has once again brought the debate over Fed's independence to the forefront. We've also seen U.S. President Donald Trump renewing his calls for rate cuts following the U.S. inflation data. Do you think Fed's independence is at risk this year?
Again, thank you for having me. It is a pleasure. We don't believe that the Fed independence is at stake. And when it comes to the view on rates for the course of 2026, the view was the Fed most likely would have cut in January and possibly in April. But after the very strong labor report of last Thursday, currently our view is that the Fed most likely will be stable in terms of will not touch the rates for the remainder of this year, which is a reflection of, to a certain extent, of how well and how resilient the U.S. economy has been.
As we enter 2026, geopolitical risks remain firmly on the agenda. First Venezuela, then Iran, and now Greenland. These are among the key issues on the table. And JP Morgan CEO Jamie Dimon recently said that markets are underappreciating geopolitical conditions. What's your opinion on this? Do geopolitical risks concern you?
The short answer is yes. If you look at 2026, and if you were to say which are some of the biggest risks that could derail what could be an important year for deal making and an important year for financial markets in general, definitely geopolitical risk is one that comes at the top. It could play out in many different ways and it's very difficult to assess. And to a certain extent, Jamie's comments are referring to the fact that capital markets are pricing perfection right now. And therefore, any potential slippage could cause some large moves on asset prices and so on and so forth. But other than that, 2026 could be a very positive year. Again, geopolitical risks do exist. To a certain extent, they are always there, and we must not overreact.
Emerging markets delivered over 30% returns in 2025. Do you expect this momentum to continue in 2026? And which emerging markets stand out for you? And I also want to add, where does Turkey stand in this picture for you?
Absolutely. So the view is that that performance that came in 2025 will carry on in 2026 too, for a variety of different reasons, including potential depreciation of the dollar, real rate that are under control in the countries, strength of some of the equity markets in those countries, and the basic carry trade that exists in some jurisdiction. So with all of this, we remain positive on emerging markets. Coming to Turkey, it is an incredibly important country for us, for JP Morgan. We have been here over 40 years. We have a full-fledged organization. I took the decision in my previous role as CEO of Europe, the Middle East and Africa, that we needed to invest more in Turkey. And we are increasing our investment in the country and building up further our presence, which, as I said, goes back to 40 years ago.
Can we have any details of the new investments or projects?
So we want to onshore more products in order to be able to serve both the local clients and the international clients better, especially in our strength that is related to the clearing of the US dollars and so on and so forth.
As we start 2026, what are your observations? What's your outlook for global growth and inflation, and what are the biggest risks to both this year?
So, inflation, I would qualify. While we see, for instance, inflation under control in Europe. And for instance, we think that inflation is coming off substantially here in Turkey during the course of 26. Inflation in the US is lingering, hasn't really gone back to the Fed target, gone back down to the Fed target. And in that context, we have a call from a rate standpoint that where we see rates starting to increase again on the US in 2027. Why? Because we think that inflation could come back up. Some of the policies that we are observing, some of the trends, the macro trends that we are observing are inflationary in nature. And unless AI can the productivity gains coming from AI can compensate some inflationary pressures, you could see inflation coming back. For this year, 2026, going back to some of the questions you mentioned earlier, inflation, together with geopolitics and together with outcomes from AI, could be some of the positive surprises, or on the other side, some of the headwinds that the global economy might be facing.
Mr. Gori, thank you so much for joining the program.
Thank you very much for having me. It was a pleasure.
Thank you.